heart of where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Caroline Hyde at Bloomberg's World Headquarters in New York.
And I'm Ed Ludlow in San Francisco. This is Bloomberg Technology.
Coming up, Microsoft, Alphabet, AMD, look, they struggle to meet high AI expectations. We'll break down the earnings reports and discuss just how these big tech giants can prove themselves down the road.
Plus, the $55 billion question, should Musk's payday go away? A Delaware judge thinks so and has voided the Tesla's CEO's compensation package. We speak to the lawyer that beat Musk in court.
And the heads of 5 of the largest social media platforms are before Congress today, testifying about what their companies are doing to keep kids safe online. We're live from DC later in the hour. But first, let's check in on these markets. And look, this is a macro story as we brace ourselves to what the Federal Reserve does or doesn't say, how we insinuate whether or not March is indeed live for a rate cut, and also some of the data showing that, look, some of the inflationary pressures are dialing back. The labor market perhaps a little bit weaker today than it was yesterday in terms of the overall macro readings. But remember, also looking at what the Treasury is going to be doing in terms of debt sales. And, well, it eased some investors' concerns. The Nasdaq, though, is really being pulled down on some of the micro and some of the earnings deliveries that we're going to talk about. We're up by 1.5%. The 2-year yield crushing down some 14 basis points. That's as we anticipate perhaps less debt sales going on into the future. That really impacted the front end of the curve and indeed the 10-year. We're looking at this particular Bancorp now. Remember, New York Community Bancorp rings a bell because it bought the deposits of Signature Bank. Remember back in March of 2023 when we had the regional bank crisis, Signature, of course, exposure to crypto, didn't sell those loans in particular to Bancorp. Nevertheless, a big shock in terms of dividend cut and overall worsening of the loans and indeed exposure that they have to the consumer base by 34%. Moving on, look at what's happening in crypto though, Ed, because I want to shine a light on the fact that we're just off by about 0.5%. We were actually higher on the day. We managed to be pulling back a little bit. 43,000 is where we trade. Look, this is all around the macro picture. When we see risk assets sell off like tech stocks, we're going to see crypto down as well, Ed.
The 3 big AI names have reported their earnings. Get right to AMD. It is concern about their outlook for the current period and a lack of rebound in end markets, an echo from what we heard with Intel. And at the same time, their AI accelerator, the MI300, ramped really well in the quarter gone, and they exceeded that guidance they'd given us that there will be a $400 million contribution to revenues from the MI300. So what's going on here? Because the stock is down. Later today, we will speak to Lisa Su, the CEO of AMD, and work out what the AI story is here. Similarly with Alphabet, parent of Google, the market zeroed in on the miss in the core search business, but also a worry about margins. Interesting, because the cloud outperformed. If you look at operating income for the cloud in the quarter gone, double what the street was looking for. And when I spoke to Ruth Porat, she said very matter-of-factly, there is a contribution from generative AI to what's happening in cloud, as well as our efforts to cut costs. Perhaps the winner of the 3, Microsoft. Growth in the Azure unit, 30% year-on-year, up sequentially from the prior quarter, a 6% contribution to growth in cloud from AI, according to the CFO, Amy Hood, in an interview with Bloomberg. But we're down 1.2%. This was a high bar quarter. We knew what Microsoft had invested. We wanted to see evidence that we got a boost in sales on software and a boost in sales on cloud. And we got that, but the market had very high expectations, Caroline.
I mean, to have cloud revenues up 24% year on year and that still not meet those lofty goals. Let's just talk to an investor and really what her reaction is. Ayako Yoshioka, we're pleased to say, joins us, senior portfolio consultant at Wealth Enhancement Group, holding both Google and Microsoft, among many other names. And Ayako, the overall feeling is that these companies delivered, but not enough to meet the anticipation. Do you think, let's talk about Microsoft first and foremost, that detail we got, the 6% increase in revenue because of AI, was it just that she wasn't able to paint it forward for this coming quarter that disappointed?
I don't necessarily think so. And thanks again for having me today. These stocks were up substantially year to date, up over 8%. Microsoft itself was up over or near up 70% on a trailing 12-month basis. So expectations have been high sort of going into this quarter. For Microsoft, they were able to at least quantify the impact of AI on the growth of cloud, unlike Alphabet or Google, which I think is part of the differential here in terms of why the stocks are behaving as they are.
Yeah, Alphabet, less detail on really what contribution AI will have, particularly on search. Ayako, what about the capital expenditure that both companies are having to give at the moment, the investment to bring about the AI prowess? Is it too much?
I don't know if it's too much. It is definitely what is needed. I mean, NVIDIA has talked about the pricing of their chips, and both Alphabet and Microsoft talked about CapEx increasing substantially in 2024 relative to 2023. And so that will be an extra spend by both of these into data centers and servers. And that's going to, help build out the infrastructure in which AI and all the applications can be built on.
Ayako, Dan Ives at Wedbush has this note out that Satya Nadella delivered a masterpiece that should be hung up in the Louvre. The stock is down 1.2%. Expectations were high, as I went on about earlier. I guess the question for someone like you that holds a decent chunk of Microsoft shares is, did you see enough in the financials to keep buying into the stock long term and believe in the AI story?
I think in the near term, Ed, we obviously expected a little bit of a pullback. As I said, the stocks really reflected a lot of high expectations. And so, with any pullback, there is an opportunity. I think it'd be nice to have the stock pullback additionally in order to have new entry points. And for most people, I think Microsoft is already a core position. So we just have to let the dust settle on the stock, at least in the near term.
Ayako, Alphabet, parent of Google, is down severely. And we're trying to understand what the focus is here. Initially, it seemed like the anxiety was the core search business. Then people started talking about margins. But if you take into account the one-time charge from headcount reduction and cost, margins look a bit better. And on an operating income basis, the clouds did great. They're saying, well, we think Gen AI is contributing here. Why are they not getting credit for that cloud story?
Sure. And, they focused on operating income efficiencies over the last year. And I think that's been a great story for Alphabet. And, they've delivered on those promises. I think the issue with Alphabet is really just getting out there and telling the story and quantifying the impact of AI into the cloud. I mean, and Microsoft talked about how there was a 6% contribution. And despite the spend that they are doing in order to broaden out that infrastructure, they also saw some leverage in their operating income there. So we'd love to see more detail from Alphabet in terms of how that's going to come about. Perhaps we'll get that once they launch Gemini Ultra later this year, which will, really impact Alphabet's Google Cloud division.
Ayako Yoshioka, Senior Portfolio Consultant at Wealth Enhancement. Great to have you on the show across so many earnings. Thank you. The next earnings on the dock is AMD. Let's break down those results with Pierre Ferragu, who heads up the Global Technology Infrastructure Research Team at New Street Research. Pierre, great to see you. For me, the story on AMD is which is more concerning or important to the market, right? The outlook for the current period, which makes us worried about broad end markets, or the progress they made on MI300, because they showed a lot of progress. Where's your head at?
Well, if you look at the stock over let's say a 2-3 year horizon, very clearly the way I look at it is that the CPU business is going to stabilize, Intel is coming back, that market is going to balance out, and really AMD managed to build over the last 5 years a very sustainable challenger position. So not much is going to happen, but it's a very strong, very solid base. Then, the embedded part of the business, the Xilinx part of the business is very cyclical, and it's going down at the moment. It's really coming down. It hasn't reached the trough yet, but the trough is in line of sight. And then you have this amazing opportunity in AI. The way I read the situation today is that AMD is the only alternative to NVIDIA with a relatively general purpose, very similar GPU architecture, which means that for all these people who, number one, find it difficult to get enough NVIDIA chips, and number two, want to have an alternative supplier, AMD with the MI300 is probably a no-brainer. And that ramp is fascinating. And so we are talking AMD potentially being, if AMD does $3.5 or $4 billion of GPU revenues this year, that means at the end of the year, they will be at $5, maybe $6 billion of run rate. Because they're going to become what NVIDIA was like, 18 months ago? 18 months ago in just a year. That's fascinating.
I mean, Pierre, you got a $225 price target. You've got a buy recommendation. I mean, what, therefore, is the catalyst to get us from 165 to that 225? Is it articulation from Lisa Su how they're going to end up seeing the rewards of the AI?
That's a great question. Let me give you first what I look at. My only question on NVIDIA, on AMD's, is execution. Does MI300 get into the hands of clients? And do these clients find it reasonably easy, because it's never easy, to ramp that new architecture along with NVIDIA? And if that happens, then it's like my price target is actually probably far too cautious. So that's the way I would look at it. So between now and the end of this year, I want to hear feedback from AMD clients. I want to see volumes ramping and people being like, yes, we're not using so much of the GPUs, we're going to continue to use them. How the street looks at it is a bit different. I think there is an element of earnings momentum. And of course, from that perspective, embedded is still, with gaming in a down cycle, CPU is uncertain. And of course, everybody understands the upside on GPU, and people start putting up expectations that are not like on solid ground. And when expectations are too high, even if AMD talks about something fascinating happening this year, there is a bit of a technical disappointment, and that's the reason why the stock is a bit weak today.
Pierre, in terms of what you still want to hear, and I would never ask you to do my job for me, but I am going to speak to Lisa Su a little later on this morning. What is the question that's not been answered in this earnings cycle? What would you ask her?
First, say hello for me, and then the question I would ask her at this stage is, when do you think you will have like a very strong visibility on whether your clients are comfortable ramping for the long run, for the long term, MI300 along NVIDIA? It's probably too early to say. Does she need 6 months to have confidence in that? Does she need a year? I'm not too sure.
We really appreciate you, Pierre, giving your a few little hints for Ed a little bit later with Lisa Su. Pierre Ferragu, we thank you so much. New Street Research Global Tech Infrastructure Lead. Coming up, well, we're going to be discussing Elon Musk's $55 billion pay package that is struck down by a Delaware judge. Up next, we'll speak with one of those key lawyers representing the shareholder who challenged the compensation and won. Meanwhile, we're also looking at what's happening on Capitol Hill right now. Klobuchar are currently questioning what is 5 heads of social media companies. We know the CEOs that are going to be getting the biggest grilling. It's going to be Shou Chew, of course, of TikTok, and Mark Zuckerberg of Meta. But he's alongside, of course, plenty of other companies, whether it be indeed Snapchat. There we see Mark Zuckerberg answering that question. We'll be going there next. This is Bloomberg Technology.
Every single app that their children use. I think the right place to do this, and a place where it'd be actually very easy for it to work, is within the app stores themselves, where my understanding is Apple and Google already.
Elon Musk's $55 billion Tesla pay package has been struck down by a judge in Delaware. That's after shareholder Richard Tanetta challenged it as excessive. The ruling leaves the fortune of the world's richest man now kind of up in the air. He'll only be the 3rd world's richest person. Cry, cry. Joining us now for more is Bloomberg's Max Chafkin, and of course one of the lawyers for Richard Tanetta. It is Greg Ferrallo. He's from Bernstein, Litowitz, Berger and Grossman. Bloomberg reached out to Musk and his lawyer, Evan Chesler, but we have not received a response thus far. But Greg, I turn to you. This was a long, hard-fought case, and I think actually the judge said, look, the defense tried very hard, but it was almost an impossible task. Will you expect an appeals now? Do you think that the board will go back and just try to restructure some sort of payment for Elon?
Wouldn't surprise me at all if we saw an appeal. Under Delaware practice, there is a direct appeal to the Delaware Supreme Court, which has the final word on matters like this. So it's likely there'll be an appeal. And
Max, from Elon Inc., your expertise of all things, I mean, he has been avidly against Delaware more broadly. Clearly, there has been concerns about, from Elon himself, a lack of control of his own company now. What do you think happens after this pay package?
I mean, this is a huge development, not just because of the amount of money that is at stake in these options, the value of the options. I've seen, figures as high as 50 billion reported. Of course, he hasn't exercised them yet, but also because this kind of throws not just Tesla into chaos. They have to figure out a way to try to retain Elon Musk. He's already been sort of making these kind of veiled threats that he might be doing AI research outside of the company if he doesn't get a bigger pay package. And then at the same time, you have all his other companies, which of course depend on his financing. And we remember one of the one of the reasons he wanted all this money supposedly was to pay for his, Mars exploration. So you have to ask where all of this goes. Last thing I'll say is this is another big loss on Delaware. Remember, Delaware forced him to buy Twitter for $44 billion. So now, even for the world's richest man, $44 billion, $50 billion, that's starting to add up.
Greg, good morning. It's Ed in San Francisco. As far as I can tell, you and your clients are the only ones to actually ever take a look at the compensation package. So as a starting point, Greg, what was it in the first place that worried you or that you thought was unusual about the package that caused you and your clients to look?
I have to say that I have a hard time articulating $55 billion. I often misspeak and say $55 million. $55 billion is such a large pay package that it basically skewed dramatically upward the entire data set for the compensation consulting industry. I think we put out a press release yesterday referring to it as a gargantuan package. Let me start by saying it was so large that we looked at it specifically because no one had ever tried to come this close. And oh, by the way, when you look at the nearest comparable, it's Elon's prior pay package.
Okay, but Greg, here's the thing. It may be the biggest compensation package in history, but there are a really large body of Tesla investors out there that say, so what? 73% of those investors voted in favor of the package in 2018 when it was awarded. And there is a big body of people out there, Greg, I hope you don't mind me saying, that are pretty mad at you and your client who are Tesla shareholders because they say, look at the share performance of Tesla since that package was awarded. Look at Tesla's position as the market incumbent in EVs and their growth globally in other products. Why does it matter?
Well, there's this idea in efficient capital markets that shareholders ought to have a say in things like this, and this package was in fact put to shareholders. But it was put to shareholders on a proxy that the court found to be materially misleading in several respects. And look, the bottom line is capital markets don't work if you don't tell stockholders material facts when asking them to take action. And that's exactly what happened here.
Max, this puts into question the board in particular. The accusations from many an investor is there is no pushback. The judge articulated there was at no point any sort of questioning that this pay package was ever perhaps excessive. What does it mean for the board of Tesla?
Well, it's not clear to me. It's as Ed is kind of hinting at, many Tesla shareholders were aware that the Tesla board of directors was essentially a rubber stamp, right? You have a lot of people who are very close friends with Elon, and I think one of the reasons he lost his case is because you had nominally independent directors who were going on vacation with him and we had clearly had a close relationship with. Now, that's kind of like how Elon Musk has done business. And by Elon, what's so, I think, difficult about this going forward is that that's kind of been, if you asked Elon Musk, like, what is your playbook? How have you been able to achieve so much? He would say, well, it's because I have I've been able to do essentially whatever I want to do. And again, as I said earlier, he's been asking for even more control from where he got. So I don't know where that goes. I do think there is some piece of risk that probably didn't exist yesterday that Elon Musk could either threaten to or even, and again, I think this is a far off possibility, decide to walk away from Tesla?
I mean, this is why the share price is somewhat under pressure, not massive moves, Greg. But the articulation from the judge was, at no point did it seem that this $55 billion or these options awarded was necessary to keep Elon motivated. But then, to that end, why not recompense the leader, a founder, with such a significant upside if he's going to deliver for shareholders?
Well, the judge made the point, I think, very cogently, and that is, I believe his net worth increased in increments of $10 billion based on the stock he already held without this pay package for each increment that was identified in this pay package. And so I think the judge's point of view was, if you look at other successful founders, Bezos, Zuckerberg, others, they don't take pay packages, or they don't take any material pay package. They rely on driving value for their shareholders in their own underlying stock. Mr. Musk had the opportunity to increase his net worth by almost $100 billion. I have to stop and make sure I get the B right. $100 billion if he accomplished what he set out to accomplish under this pay package without getting a single option. And, you know, at the end of the day, this is a car company. It's not a space exploration company. And it's a public company. And public companies live by different rules than private companies.
Right. If you're watching us live now on Bloomberg Television and you're a terminal subscriber, you can send questions to us via IB. Greg, I told our audience on social media you were coming on, and that there were lots of questions. I think the most common is just a want for deeper understanding of what the pathway forward is. So you talked with Caroline about a likely appeal. I think my understanding from sources is that's likely as well. But the other thing is that this current board, which is different to what it was in 2018, could put together a new compensation plan and then take it to shareholders to be ratified. How involved do you think you will be with your client? How involved do you think Kathleen J. McCormick will be in that process, if at all?
Well, the simple answer to that is that's a question for the board to determine in the first instance. And assuming it fulfills its fiduciary duties and uses ordinary and reasonable means to arrive at a result, my guess is I won't be involved at all. And my guess as well is the judge won't be involved at all. If the board comes out with a package which either facially is ridiculous, gargantuan, or otherwise raises concerns from a fiduciary perspective, I suspect you'll see my firm and I involved as well.
Right, Max, there's so much to discuss here. I guess the board could also say, well, here's another $55 billion package. Looks different, same number.
I mean, one thing I'm curious about, you know, Musk overnight was sort of threatening to leave Delaware and to reincorporate in Texas, I believe, or, you know, I think he moved from Delaware to Nevada. Is that can he do that? And is that like will there be another sort of tranche of lawsuits if it happens because shareholders will say, oh, he's just doing this to reduce our rights or something?
So look, the simple answer to that is Musk can't do anything himself. That's a matter that the board has to decide in the first instance, and then it's presented to shareholders for a vote. If shareholders, upon the board's recommendation, decide to move to Nevada, they have a right to do that. But it's not a Musk decision. Let me also say that I'm not an expert in all 50 states' laws, but I suspect, I would guess that even Nevada prohibits you from putting out misleading proxy statements. And that if Musk wants to go to Nevada and do the same thing, he's probably going to run into some problems there as well. It's this little idea of telling the truth. You know, it's real basic.
Right. Hey, Greg, real quick, an audience question that I'm just going to read. Do you worry about changing the norms around Delaware corporate law away from non-intervention? That was a follow-on from what Max asked. We have about 30 seconds.
No, not at all. I think it's very important to recognize, and this is something that's deeply embedded in Delaware law, that every decision is twice tested, both from a legal perspective and an equitable perspective. And when fiduciaries act in a way that's not equitable or in violation of their duties, you're squarely within the long tradition of the Delaware law to call them on that.
I'd point out that Tesla had a sharp reaction after hours. It's now down just 0.4%. We thank Greg Villaro, lawyer at Bernstein, Litowitz, Berger and Grossman, and of course, friend of the show, Bloomberg's Max Chafkin. Coming up, media mogul Byron Allen makes another multi-billion-dollar takeover offer for Paramount. That's next. This is Bloomberg Technology.
Actually, I'm very bullish for the S&P 500, not just for the Magnificent Seven.
The enthusiasm for the Magnificent Seven will continue.
As you look at the Mag 7, they're companies that have a broad exposure.
I think semiconductors will continue to be strong.
I think we have to look at areas like semiconductors where AI could drive a lot more demand going forward.
I think 24 is really about differentiation. Some will be determined that they really aren't true AI beneficiaries.
Some of them are right and some of them were wrong. Welcome back to Bloomberg Technology. Ed Ludlow here in San Francisco. And in the markets context, this is what the session looks like right now. In the moment, you can see the NASDAQ 100 softer by 1.4%. The earnings story, a big contributor to that. Microsoft off 1.3%. Despite delivering what was a strong quarter, there was evidence that AI made meaningful contributions to the top and bottom line, but it was a high bar quarter. Investors just wanted more. But largely that was the positive story. More worrying, AMD, now softer 3%, gave a worrying outlook for the current period. Remember, they go into lots of end markets where we're just not seeing the rebound we thought we would. But the AI story was strong, right? Their AI accelerator, MI300, they ramped production in the quarter to a reasonable volume and exceeded their sales guidance that they'd previously given. Investors still a little concerned. Then there's what's happening away from earnings in the media landscape. A big bid for Paramount from Byron Allen. That stock is now up 7.8%. It had been much higher. What about that conversation we were having, Caroline, about Paramount and Warner Brothers Discovery? And then in the back of your mind, remember, somebody recently suggested that ESPN Plus goes on Netflix and Disney. What is happening here? I think we have a good conversation coming up. Yeah,
so much to discuss. Weird. Activist investors meets desire to make some big bids on some TV assets. Let's return to the comedian turned TV media mogul, Byron Allen, because his latest takeover attempt is a massive one, Ed. $14 billion he's offering for Paramount in a text. The media mogul made basically that offer for voting shares of the company at a 50% premium to recent trading, according to sources. Now, when you include existing debt of Paramount, total value of the deal, $30 billion. Here with more is US media analyst for Bloomberg Intelligence, Geetha Ranganathan. And I mean, ultimately, do you think this is a realistic deal? Byron Allen is known for making, well, waves in media landscape and headlines, but is this a realistic deal that he could follow through with?
It's definitely a solid deal, Caroline. I mean, the premiums are solid, and this is really the first full cash bid that Paramount has received for all of the company. Having said that, though, I mean, you're absolutely right. Byron Allen has kind of been in the thick of all of the media conversations, right? He's been making bids all over the place, whether it was for, Disney's linear assets, whether it was for BET, TV stations from Scripps. So I think it's still, the market at least, I think, views this as pretty much a long shot. Just kind of given that, there is a huge amount of debt, as you pointed out, over $15 billion. Paramount is one of the most levered companies in the media world, over 5 times. And financing is definitely going to be a problem, especially in the current market environment.
Geetha, I want to do the math. You're right, $15.6 billion on the debt side. The offer is $14 billion. Paramount's current market capitalization is $9.95 billion. But I guess what I don't understand is, where's Byron getting this number from? Where is the value? Forget the kind of risk on the debt side, but what is it that Paramount offers? All can be fixed.
Paramount actually offers a lot. I mean, it is a very compelling collection of assets. One could argue that, yes, they do have a very heavy exposure to TV networks, linear networks like the CBS broadcast network, like Nickelodeon, Comedy Central, which are all in secular decline. And remember, I mean, advertising every quarter, if you look at TV advertising, it's down about 10-15%. Affiliate fees, again, down because of cord cutting. Almost, 8 to 9 to 10% of cord cutting is what we're seeing. quarter in and quarter out. So yeah, I mean, it's definitely a tough landscape. But having said that, I mean, the linear networks still throw out a decent amount of cash. But I think more importantly, is really the content assets. Paramount has an absolutely formidable content production arm, whether it is the film studio or the television studio. And that is really what a lot of the other suitors, I'm not necessarily sure whether Byron Allen is looking at the studio itself, but we know that, Skydance Media, backed by David Ellison, has been very interested in Paramount and kind of combining it with Skydance, as well as Apollo, and of course, Warner Brothers Discovery as well.
Nickelodeon, blast from the past. When I was a kid, Rugrats, Wild Thornberrys, that was my jam. And if you know what I'm talking about on social media, at me, I don't care. No shame there. US media analyst for Bloomberg Intelligence, Geeta Ranganathan. Nickelodeon, my goodness. Let's keep the conversation going and bring in Laura Martin, senior entertainment analyst at Needham. And let's get right to it. Byron, buying Paramount. Thoughts?
Right. Fantastic for Paramount shareholders. This company is too small. It needs to have a different management team. I like the idea of splitting it up. It's worth more in pieces than together. We need new management here. Great idea.
So this is a stock that you cover, and Caroline and I have been talking over recent days kind of broadly what's happening here. Take into account this proposal that ESPN Plus, from Nelson Peltz, according to Bloomberg sources, does something with Netflix. It's still an industry where they're trying to kind of right-size and find the formula for profit, is at least my read on all this news flow.
So on ESPN, I don't think Nelson Peltz will actually win his board seat. So I think ESPN will stay part of the Walt Disney Company. I think a far more interesting value creative solution for ESPN is to get the NBA and the NFL to take pieces, like equity pieces in ESPN. And they basically ESPN become the anchor tenant streaming, like linear and TV streaming for the leagues. That's a good idea. Sort of like what Hulu used to be for entertainment. I think the professional sports league should do that with ESPN Plus. Much better idea than selling it to Netflix.
Just taking that step back, Laura, and the idea that M&A seems inevitable in 2024 in some way, shape or form. Who become the key players left in your mind's eye? Who are the winners from all of this?
Bigger. You must be bigger. So who you're competing with here is Amazon Prime Video. And Amazon never needs to make money from streaming. So that's your competitor. My opinion is Apple comes in eventually, but they're not really a serious player today. They spend $2 billion on content. And as we know, Netflix spends $17 billion without sports content. So these players the winners are going to be the Walt Disney Company, in my opinion. Either it gets bought or it's just big enough with enough IP franchises to win. And I think Warner Brothers Discovery is like the dark horse. But I got to tell you, Paramount is too small. There is no advantages to small size in this war.
What's interesting, Laura, is also we were originally bringing you on to talk about the earnings, the fact that we have, advertising looking pretty good when you're looking at YouTube, for example, and Alphabet out there managing to still bring in the ad revenue when everyone really wants to hear about AI. But from your perspective, Laura, what is it that some of these tech companies and Alphabet, for example, can bring to the table when it comes to our own consumption of content?
So I think what's really interesting about Google's strategic position, Alphabet's strategic position, is YouTube is now the #1 streamed entity. And YouTube advertising grew 16%, and they're now up to, we think, $3 billion in subscription revenue, which is sort of hidden in the other line. You have to sort of go digging. But they said they had 100 million subscribers and $15 billion in subscription revenue last year. So this is another revenue stream sort of building up under the sheets, and it's all video all the time. YouTube TV with the NFL Sunday Ticket, really, really rapid adoption. It's almost doubled their subscribers, that product.
Laura, I guess going into the earnings and coming out of it, it simply came down to understanding the AI story in a way that Google or Alphabet demonstrates they can make money from all of this investment and chat. Do you now have a better understanding of that?
Yeah, I think what's really interesting about, they said AI 67 times in their transcript, and they said generative AI 12. I think what's really interesting is their margins. They hired 0 extra headcount. They grew revenue at 13% with no extra costs. So guess what's happening to free cash flow? Operating margins went up 500 basis points to 27%. these companies that are now integrating generative AI and AI not only are having faster product innovation and product introductions, they're also cutting costs already. They're not using as many people. You keep seeing Alphabet, releasing statements saying it's cutting more people. This is all about automation. So my opinion is the faster companies adopt generative AI and machine learning AI, the faster costs go down because you're replacing people with machines.
It's tough, but from a bottom line, it's positive. Laura Martin, it's so good to have you on the show, as always. We thank you, just going the whole gamut of the media landscape with our senior entertainment analyst over at Needham. Stay well. Meanwhile, coming up, look, tech leaders, they've descended on Capitol Hill to testify at a Senate hearing focused on children's digital safety. We're going to have so much more on this as we go live to Washington. That's next. This is Bloomberg Technology.
There is a problem with accountability because these conditions continue to persist.
Okay, tech CEOs across Meta, X, Snap, TikTok, and more have descended on Capitol Hill to testify at a Senate hearing focused on children's online safety. Joining us live from Washington, Bloomberg's Alex Barinka. In any of these hearings, you have to take the prepared remarks of the speakers, the CEOs themselves, and then see what happens with the line of questioning, which can sometimes be outside the scope of the brief. What have we learned so far?
Well, so far, both the tech CEOs and the senators in the hearing room came to the room with a lot of vigor for those prepared remarks. It started with Senator Durbin showing a somber video of victims who had experienced sexual exploitation online, and went into Senator Graham telling Mark Zuckerberg, the CEO of Meta, and the other CEOs on the witness table inexplicably that they have, quote, blood on their hands. The hearing room erupted in applause. After those prepared remarks, we did get some news from the likes of Linda Yaccarino, the CEO of X, who said that her company would be the first to support the Stop CSAM Act, an act that is meant to protect victims of who have their sexual images uploaded online and expand the reporting process for them with the tech companies. As we speak, the questioning is still going on, and some of those back and forths have gotten a little bit testy, particularly as we get into the day after the prepared remarks.
All of this comes as bills and legislation is debated, but ultimately goes nowhere, Alex. Is there any sense that some sort of rules will change for ultimate liability for these companies? Or in general, is this more about self-regulation still?
I can tell you Senator Klobuchar had her 7 minutes of questioning, and she had quite an exasperated tone because she said this conversation has been going on for more than a decade now. She had a really pointed statement. She talked about the issues with the Boeing planes, saying if we have a piece of a plane fall off and threaten lives, we ground those planes. If there are children dying from interactions online by suicide or by coming in contact with sexual predators, why aren't we doing that? So that exasperation is certainly felt in the members on both sides of the aisle. But we did hear folks like Republican Senator Lindsey Graham come to the table today saying Republicans are happy to come to the table. Meanwhile, there is kind of folks across the aisle who have bills in motion. That being said, we've seen bills before that aim to rein in the power of big tech. When there are children's lives and children's safety on the line, perhaps this is the moment that they can actually get things over the line.
Alex, kind of in parallel and adjacent to this, Bloomberg's reporting with regards to Meta that previously some executives went to Mark Zuckerberg and said, we need to hire more people focused on child's online safety in terms of headcount. And that proposal was rejected by Zuckerberg. What's the story there, and what has the company's response been?
Sure, and I actually heard from Senators Blackburn and Blumenthal yesterday before the hearing who talked about these emails that the committee is releasing in accordance with this hearing. They're from around the time of September 2021, from a letter from those two senators. In response, Nick Clegg, Meta's head of policy, basically came to Mark Zuckerberg saying, hey, I have a plan here for additional investment in wellness. It's very important. It's a top issue, and we're having outside pressure. Can we look at this plan and invest in it? Those emails went unanswered. considered for a number of months, and ultimately that investment was pushed back upon. I do expect that the senators will bring this idea up today and query Mark Zuckerberg himself and, pose the question, why haven't we seen additional investment? You have so many engineers, so much headcount. In 2021, you hired more than 10,000 people. Why isn't there more being done to protect kids on Meta's platforms?
Alex Barinka, we thank you for bringing us the latest on the reporting and indeed the questioning that's going on the Hill right now. We want to stick with that hearing and ultimately what policy could potentially come from it. The Center of Humane Technology Policy Director, Camille Carton, joins us now to really discuss where they think real change can happen to protect children on social media and what these hearings really mean for big tech. Ultimately, Camille, what, if any, policy can be put in place to ensure that children are that little bit safer? We can't cure humanity, but we can potentially hope that we put some barriers in place, whether it's technology or indeed just policy more broadly.
Yeah, absolutely. I think we're at a point, as everyone has said so far, where we are happy that these hearings are happening because the public needs to see it, but we're also at the point in our democratic process where it's time to push forward change. And some of the things that we look for in bills, specifically around kid safety, are three main pillars. We want a duty of care, which essentially means just like a doctor has a fiduciary responsibility to ensure that patients are treated in their best interest, we want platforms to ensure that kids are not harmed on their platforms. We want privacy by default. This means if a kid goes onto Instagram, the moment they sign up, they have all of their settings at the highest level of privacy. It means that they won't get messages from people that they're not friends with. Their profiles won't be able to be seen by extra people. And we want safety by design. We want no more addictive features that are known to be harmful to kids that platforms continue to utilize because it keeps them on longer.
I'm going back to that privacy focus. Now, some companies, I think of one in France, Yubo, that came onto the show last week, saying how ultimately you can use technology as a force for good here. You can have some sort of ability to really age appropriately who really is part of using that system. But then privacy comes into it. How do you allow the camera to identify whether a child is indeed the age they say they are without in some way impacting their own privacy? How do you see technology being the solve here?
Yeah, I think that that's a great point. But part of what's missing is that these companies already have age estimation tools that they use to know the age of their users. I mean, one thing that came out of the AG lawsuit that's happening across 41 states is the fact that Meta knows that it has millions of users under the age of 13 on its platform, and it's keeping that knowledge from the public. So they know this, and they use their estimation tools to actually target against these kids and to target advertising to age ranges. So we actually don't need new technology. Companies already have this information. We just need them to enforce it.
Camille, I still go back to the idea that when this Senate hearing is finished, what comes out of it? Because many of the social media companies have codified policy, right? So if you take TikTok as an example, they have restrictions on age. I think 13 is the barrier to using TikTok. And those are policies. The question seems to be on enforcement. And as Caroline rightly points out, either a lack of or use of technology to enforce those policies. And I just wonder what your perspective is on policy versus action.
Yeah, I think the fundamental difference that we're talking about, though, is self-regulation policy by these platforms, which is where we're at right now, as opposed to regulation that's codified in law. So these platforms at any moment can change their terms and conditions. And what we're seeing right now is that they release features that folks have been asking for years ahead of a big PR moment. And that's great. We want these better features, but releasing these features because of a PR moment is no substitute for regulation that incentivizes safe innovation and age-appropriate strategies from the beginning.
Camille, Pinterest's CEO Bill Ready has an op-ed in The Hill this morning likening the social media industry to big tobacco. That is something I've heard before. Why do you think social media companies would do something like that? Are they trying to get in the psyche of lawmakers and show that they're on the same wavelength or something like that?
Well, I think every social media company and the ways in which they utilize their products are different. Pinterest has a different business model and a different position than other social media companies. We've seen that with Snap coming out and endorsing the Kids Online Safety Act, now with X coming out and endorsing CSAM. They're all taking slightly different positions, but I think the main takeaway here is that we're starting to see them come to the table. There's overwhelming support by parents, by AGs. I mean, schools are suing these platforms. And I think that they're realizing that the time is up of this move fast and break things mentality, and we need to come to the table and figure out exactly what a path forward looks like. And that path does require regulation in the same way that we had to have with tobacco.
Okay, as we say, the hearing's ongoing. Senator Ted Cruz using props behind him. You can tune into that hearing for the full details. Center for Humane Technology Policy Director, Camille Carlton. Fantastic conversation. Thank you. Now, coming up here on Bloomberg Technology, Universal Music Group calling out TikTok as the two companies renegotiate how music and AI is used on the social media platform. We're going to have that chat next. This is Bloomberg Technology.
Time now for what's going viral. TikTok may find itself without music from thousands of artists represented by Universal Music Group. UMG has issued an open letter to the ByteDance-owned company, condemning it for offering unfair terms during licensing negotiations. Now, UMG is posting on X that it must call time out on TikTok. Ed, this is about TikTok saying, look, you get free promotion for your stars by the music on TikTok, but UMG saying you are using AI that is going to ultimately take away the power of our own artists.
I go to what Satya Nadella said on that NBC interview in the context of them in the New York Times. It's going to come down to intellectual property versus fair use. That's a different medium, music, but that's the case.
Yeah, Citigroup saying, look, these are going to be difficult negotiations, but actually I think UMG is taking the right stance. The best, it secures better terms. The worst, looks like they protect their artists. That does it for this edition of Bloomberg Technology, Ed.
Check out the pod. This is Bloomberg.